Good morning and welcome to the June 2026 edition of Tech Tuesdays with Darrow Associates, now in our fifth year of this series. I'm Jordan Darrow, and it's a pleasure to be here with you. This is our monthly IR technology and service showcase held on the first Tuesday of each month from 11 to 11:30 a.m. Eastern Time. Our events are a one-stop destination to find the right products and service providers to maximize your effectiveness and ensure you have the tools to achieve your investor relations goals. Each showcase provides a continuing education platform for our partners to demonstrate their cutting-edge offerings and best practices to our staff, our clients, and other friends of the firm. A different IR tool is covered each month. Our sessions are provided in a virtual format with a screen-shared presentation led by the presenting partner for approximately 15 to 20 minutes, followed by a short Q&A session. This week, or rather I should say this month, we're pleased to have Paul Matiychuk from DealMaker with us to talk about raising capital online through their digital marketing platform. As he talks with us, you'll see his screen and all audio lines will be left open so that you may ask questions at any time. If you don't want to be heard or have background noise, please disable your microphone. Paul, welcome to Tech Tuesdays with Darrow Associates, and thank you for being our partner. I'm now going to turn the call over to you so that you can present your platform to our viewers.
Great. Thanks very much, Jordan. Pleasure to be here and to be with you, and we appreciate the invite. I'm going to go ahead and share a slide deck we have. I'll be going through this. I don't want to read through it, but I invite you to stop and ask questions as we continue through. But just a brief introduction. I work for DealMaker. DealMaker is a group of companies. We are a broker-dealer. We're a technology platform that I'll kind of show you here, an SEC-registered transfer agent, as well as a marketing firm. We've been around now since 2018. I've been with the company since 2021. I joke I had hair when I started, but I've worked on so many deals it's slowly receded away. But a little bit about us. We've been the leader in community capital. So since 2018, we've raised $2.6 billion from about 950 offerings. Some of our big logos here, the Green Bay Packers, Picasso, EnergyX. We've done everything from private placements, seed round, to the Newsmax IPO. We were on the part of the Reg A part of that. So really want to take you guys through how this works online. It's a different way to raise capital. It's a little bit of a novel way, but really we think it's the next evolution of the capital markets, and that's really going direct to community and building up a strong shareholder base when you're still private so that you can really reap the benefits when you go public. So the two offering exemptions that we work with are Reg CF. So that's up to $5 million annually. US issuers only. You can market and solicit the offering and accept accredited and non-accredited investors. And then the second one is Regulation A plus. So the Reg CF is an intermediary offering. The Reg A is a direct offering. You get qualified by the SEC. You can raise up to $75 million for Canadian and US issuers. Both public and private companies can use this. There's been about $10 billion raised in Reg A since 2015. Of that, we have become the market leader. So last year, we did about 54% of all the funds raised through Reg A. The year before that was 51%. So this is really our focus area and specialty, right? And so why do companies raise capital this way? Number of reasons. The big one right now, traditional fundraising is really hard, right? We can see that OpenAI, SpaceX, Anthropic, they're really sucking up a large portion of the capital and a lot of the investor focus. And for VCs, if you're a private company, if you're not in AI, and if you're not one of these three or four companies, you're pretty much getting ignored, right? When it comes to public companies, same idea, right? There's the biggest companies on the market sucking up all the attention and investor interest, and everyone else is having to do private placements or pipes at not great terms, or they're struggling to raise, right? And that takes a lot of time. And usually you have to give up a lot these days if you're trying to raise, whether that's in dilution and board seats or control. And those rounds don't compound, right? They take a number of months, lots of due diligence, lots of work, lots of busy work, but it really results in a lot of wasted time where the founder isn't going to be working on the business, right? 75% of the time spent raising capital, during a fundraise actually goes to that portion. That means the business gets ignored, the growth objectives get missed. You're really stagnating the business, right? And there's a lot of extra work that goes into that. And by the time you've successfully raised, you're diluted, right? The company has given up a ton of either control, board seats, liquidation preferences. It's not a great system, right? And so, there's a lot of risk to that. We believe that companies actually have an asset class available to them that is being underutilized, and that is their community, right? And so the way we kind of see the world is that people that interact with brands, that buy products, that use business, use services, they are that company's community. They believe in the company, they know what it does, they love the product, that's why they do business with it. And there is an opportunity to unlock those folks and turn them into investors, as we call, right? And it's the same way that a company raises capital, they can go to their customers, shareholders, and get them to become investors, to become stakeholders in the business. And this kind of overlap is really what the capital markets is moving to, right? Community focused, fan focused capital, where the business is able to benefit from, increasing their shareholder base, from having people that are going to refer to the business, that are going to be brand evangelists, that are going to be able to make introductions and so on and so forth for that business, right? And so why are people doing this? A couple of reasons on the slide. I'm not going to read all of them, but apart from it being friendly capital, right? They're going and they're able to sell more products. They're able to use this to grow their revenues. For example, we did a white paper and we see that businesses that have raised funds from the community tend to see a 64% lift in revenue, in year-over-year customer loyalty, and number of referrals to the business. It also helps with getting their community engaged, right? If someone is a shareholder, you know that they'll purchase more goods, they will do business with you more often. I personally use Apple products and I'm an Apple shareholder, right? It is a natural kind of thing to really invest in the companies you believe in and watch them grow because you see the benefits of their product every day, right? But also, founders do this because, as I mentioned earlier, the capital raising environment is quite difficult right now, and a lot of firms and companies are between a rock and a hard place, right? They need capital to grow the business. Capital is the lifeblood of every single business, but that capital always comes with strings, and it's a decision of how much do you want to give up, and really who do you want to answer to in order to make that business grow and succeed, right? And so most people are doing it for three big reasons: the terms and the timing, right? Founders are able to go out and management teams are able to go out and they're able to raise at a favorable valuation. They're able to offer minimally control. They're able to provide control preserving shares. So typically non-voting common shares, as an example. They're not giving up board seats. They're not having to pay a huge dividend or distribution quarterly, and they don't have to, give up crazy liquidation preferences. So if that business takes off and succeeds, they can still get something from it too, right? And that's the biggest picture of this is you want a fair price for the business, you want the capital to grow, and as a founder, you want to maintain control and still see the benefits of all the hard work that you've put in at the end of the day. The other reason people are doing this is it's really a marketing exercise. So for both public and private companies, we see a huge lift in brand awareness, in company recognition, and a lot of this goes back to being strategic, right? On an average $10 million raise, as you see here, you'll get about 4,000 investors doing this, but you also get about 40,000 emails. These are people that you can follow up with, that you can sell to, that you can put on your mailing list, that the next time you do a raise, they've been following your company, seeing your updates, which all can be provided through DealMaker Engage on our back end. Now I'll talk about that in a sec. And that way, whether it's, business expansion, figuring out where you want to expand the business to, whether that's creating more media awareness and earn media for the business, whether that's even just better understanding who your community is, right? Like a lot of this comes with building up a larger shareholder base that will be there for you as you go public or when you're public, a differentiated kind of offering. So, on the platform side, we try to make this like e-commerce. The big idea right now is everyone buys everything online, and investing is no different, right? We had the revolution during COVID with Robinhood and GameStop, and that's when retail investing really took off. After that, we had online capital raising through Reg A and Reg CF really become a much bigger piece of it, right? Folks are going out and looking for alternative investment opportunities, right? The markets, I think, are at all-time highs. People are looking for differentiated options. And so we are used to spending money online. We are used to putting in a credit card and purchasing a good or product that is a few hundred or even a couple $1,000s. So the same way that you sell products online is the same way you sell stock, right? And so we try to make that really simple. You should see here an example of someone filling out a subscription agreement, signing it, and then putting in their credit card to purchase shares in an offering, right? And we make sure that that's done in a compliant, legal manner. We have a background check functionality so that you can make sure you are comfortable with who's going onto your cap table. And all of this can be done in about 30 to 60 seconds, right? And then once they've invested, we can issue them the shares. Everything's done and there's a record that investors can log into on the back end, see their shares, see their company updates, so that the biggest thing when you build a community is making sure that you're managing it, making sure you're staying in touch and making sure you're communicating, right? Basic core functions of any IR kind of process. And so we built that to be a one-stop shop. So from start to finish, the entire life cycle, right? As you raise, you can grow the business, put out news, you can come back to a raise, and all those people are now have been following you, have been seeing your updates, have been hearing about what you've been doing, and they're that much more excited to participate in your next round. And it becomes a very efficient flywheel for you to keep growing the business.
Paul,
Yes.
um, you mentioned that you use your credit card on this, but
Mhm.
what if you're someone who has an investment account, so a 401k, an IRA, or just standard funds that are stashed somewhere in an account? Can that be used? Is that just a simple ACH hookup?
Correct. ACH, you can do a wire. We can do it through a IRA. Any of that is functionality is possible, right? I use credit card as the example because it's very novel, right? And a lot of people don't think about, putting in credit card and getting the points and investing, but yeah, I'd say about 50% of the investors are through credit card, probably 30% are through ACH, Jordan, and about 20% come through wire.
Okay, great.
Very quickly on the marketing side, how does it all work? Right? Here's some of the campaigns that we've ran, how much money they've raised with us in total. But the big idea is
Hope
it's
your
just basically,
summer, hope your summer is off to a great start.
sorry, Drew, do you have a question?
No, someone someone didn't put them on themselves on mute.
Um, yeah, so it's a basic marketing funnel, right? Our marketing team, and I have some examples right after this, you are going to drive people to a page, right? You're going to run ads on Meta, on Facebook, in newsletters, and other kind of channels. And the entire idea is to get them to a landing page. And on that landing page, we'll have a video, and I'll show you an example of this. There will be information about the offering, the share price, obviously the offering documents, and all the reasons that someone should invest in this business, right? Whether it's the revenue growth, the management team, the business's products and services, anything that makes it a differentiator. And then from there, we get them into the funnel, we start and they fund, right? And all of this is a data-driven process that we can see on the back end. So you can kind of see here, right? We create the full scope of that marketing campaign in conjunction with the issuer. So we are trying to tell a retail investor version of their story, right? They have their brand, they have why they exist, what they do, how they do it. We help them translate that into an opportunity that retail investors would be excited by. And so you can
Off
kind of
to a
see
great
here,
start. I noticed that Aaron Howe was
you can kind of see here a landing page for one of our customers, Monogram Orthopedics. You know, it's meant to be interactive and it's meant to be novel and it's meant to be engaging, right? And so very quickly, I have some links here that I will share with you guys after. We can see example ads that we run and the different ways that we produce them. You can see here some of the content we create, whether it's TV campaigns, whether it's the landing page videos, and all of this is interactable. And the big idea is these investors exist anywhere, everywhere. Investors aren't just some group of people that, you have to buy from a list or they're just sitting somewhere. It could be anybody. It's your customers, your fans, your followers, the people that already know you, like you, trust you. Those are the easiest people to get to become investors in your company, right? But everyone's looking for a great deal, whether it's frontier technology for something that is a novel product that can change the world, or it's someone looking for a consistent dividend or return. And it could be even people that really just emotionally believe it, right? They love the product. They've been buying it for years. They've done business with you for years. They want to become a shareholder to support the business, right? Those are the reasons we find people invest. And so I have some case studies we can go through. The best one, just in the interest of time, that I think highlights the full scope of the DealMaker program is Monogram Technologies, formerly Monogram Orthopedics. They raised about $80 million in total from the community, over 40,000 investors. They started with a $5 million Reg CF. They moved to Reg A. Then they did a Reg A to IPO listing on the NASDAQ as a direct listing. And then while they were public, they did a shelf offering, basically an S3 where they did the same principles, marketing online to their community, and they raised about 12 or 13 million dollars in 3 months, right? And then they were acquired. So from the entire life cycle of the business, we're able to support and provide services and work, and we're best fit to work with growth stage companies. So um, and then just a couple others, but I'll have this deck sent out after this call so that your team can review. But that's the end of the presentation, Jordan. I appreciate you for giving me some time here.
All right. Well, thanks so much. I've got a bunch of questions, so I'm going to start off. But if anyone else from the field has anything, you can jump in whenever you like, or just put it in the notes, and I'll read them for you. You really covered my first question when you started talking about Monogram, but I wanted to dig in a little bit deeper
Hmm.
because I wanted to ask what stage you believe you're best suited for, which stage of investment, meaning, are you a seed round platform, an angel round, A, B, C, Reg A plus IPO, secondary offering, and it sounds like with Monogram, they pretty much did all of that. Um,
Yeah.
but is there any areas that any stage of company that you think this is not suitable for, and who is it most suitable for? There's always going to be that outlier. And Monogram could be it, where they've used you across the board, but it's really not going to be helpful for maybe most companies that want to get on here.
Yeah, fair. So we're best suited for companies in the growth stage. So it's Series A, Series B, Series C, right? That is our very down the middle sweet spot of the best companies we're suited to work with. Like when we're looking at a company, we're evaluating it on a couple of criteria, right? Is it something that is in the zeitgeist, right? What the business does? Is it easy to explain to my 18-year-old cousin, my 80-year-old grandmother, but still is really novel and enticing and it has some sort of validation from having raised money previously, having an existing product that's selling and having revenues. That's the big core criteria we look for. There's always kind of outliers. It's really hard to do this, Jordan, if you don't already have some existing community or business operations, right? Like we can take a sports team that might not be spitting off a ton of revenue, but they have a really loyal fan base, right? And that is, or any kind of product that has a really loyal community and fan base, those are always great fits. But when it's a very early stage company without lots of press that no one really knows, that hasn't raised money yet, that doesn't have revenue, it's a really challenging kind of task unless there's other intangibles like a really great story in a hot sector or a really strong management team that has lots of previous exits. So we're really looking for Series A to C. Of course we could do pre-IPO, we've taken companies public, and we could do earlier stage, but that's where we find we have the sweet spot for really helping companies accelerate their growth.
Yeah, so you spent some time talking about the community, and you're
Hmm.
really talking about our community, meaning the company that's raising the funds. And like you mentioned, a sports team or Green Bay Packers, which is already a customer of yours. Um,
Hmm.
they've got a loyal fan base, so wouldn't it be even better to make them part of the owner group? Um, so when you're doing these offerings,
Hmm.
how much of the capital is raised from the company's community versus your community? Because I assume that once someone, say a Green Bay Packer fan, invests in Green Bay Packer, you have their details. You have access to them now. You can contact them for any other company that's raising money.
So we can, but we don't. Our entire model is that your investors are your investors, right? We believe in business. We believe in the fact that if you've worked hard to build up this list, to build a relationship, to get that trust, you should be the one that benefits from it, right? And like there are some models in the space that do the idea of like, hey, we have 2 million investors come here and you'll raise capital, but it's really hard because you are now being commoditized with all these other businesses in a marketplace. And instead of your story standing out and appealing to the people most directly to you that you've spent years cultivating, delivering great service, having a great product, you're siphoning off that share of wallet, right? So
Right.
we really believe in you can raise from your community. And like a community is, again, fans, followers. Generally we want to see an email list of at least 10,000 people, if not more. Email is the best. A social following is the second best, of course. Um, and then we supplement that with marketing, right? So each round compounds on itself. Like with Monogram, going back to Monogram, they did 3 or 4 or 5 different raises. I can't remember the exact number, but each round, right? If you go back to the slide I had over here where it talked about value, if you did a $10 million raise and got 4,000 investors, but 40,000 emails, those emails are future investors, right? And that you don't have to acquire them for the next round. So the next time you go out to raise capital, of that 40,000, maybe you get another 4,000 without spending a dollar. And then you've just got $10 million on top of what else you can raise in that round, right? So our whole approach is compounding, right? We're the best suited to work with companies that want to make this a core part of their capital strategy. Um, and community can be unlocked a lot of different ways, but we truly believe that your community is your biggest asset. We want to keep it there with you. We're not in the business of siphoning off your investors into other deals, right? And that's why people prefer to work with us.
Okay. Yeah. So essentially, when you say crowdfunding, it connotates that you're going out to the crowd, the general public. But in large part, your platform here is
Mhm.
to crowdsource the funding from the issuer's own crowd, not
And
your crowd.
yes, and supplement it with our marketing. Like if
Yeah.
our marketing has been directly, behind at least 1.5 billion in raises, right? So like we have a playbook. We know how to acquire investors. We know how to present companies. Here are some examples on this page. Um, so it is a dual factor, right? Because the company's community every business has to acquire new people, whether those are customers or followers or users or whatever, right? And so we accelerate that and we make it a dual pronged approach where on one hand, any marketing dollars you're spending is for the business purposes, right? Brand awareness, recognition, customer acquisition, revenue growth, while at the same time, that same dollar is going to capital raising, right? So it becomes two bites at the same apple, if you will. And you're able to both accelerate the business objectives and raise capital in the same process.
Okay. Um, so your offering in large part is centered on a retail offering. It's not really much of an institutional offering, although it could be institutional if someone wants to come in. It doesn't matter, or family office. In today's day and age, the way the brokerage system is working out, it's sort of like there's a lot of $100 million managers or more, up to billions of dollars that are structured as family offices, and they could easily come into one of these rounds, just doing it the same way that anyone else would. Uh, so I just wanted to ask, what is the typical breakdown between institutional retail investments in your transactions?
Yeah, the vast majority of the investors are in fact retail investors. Typically, institutions want different terms than what companies are offering in these kinds of raises. So it's a really great way to get the attention of a family office or an institution, right? Like as an example, I'll go back to Monogram. Um, you know, part of what they were doing with all the marketing is it got the attention, in this case, of a lot of like hospital systems and doctors that reached out to them in order to purchase the product, right? We've had other folks that have received interest from venture capitalists and from um, private equity firms and the like who saw the advertising, who saw what they were doing and said, hey, this is really interesting. We looked at the offering. We'd like to put a big chunk of capital in, right? Because if you get a family office on a Reg CF and they want to write you a $3 million check, you still want to keep that room for retail, and you might do a Reg D or a side letter with that family office. So it's a great way to build brand the awareness and get the name out there. But the majority of people are participating are retail investors. The average check, Jordan's $2,500 between these deals. Some deals go as high as 4,500, but it's usually these kind of individuals, whether they're accredited or unaccredited, participating, and then people are leveraging this to get the attention of these much bigger institutions and negotiating a different kind of deal with them.
So what is your sweet spot in terms of amount of capital raised? Obviously, you're going to highlight your biggest and best successes here.
Mhm.
Um, but how many deals have you done in, let's say, the last 12 months, and what's the average deal size?
Yeah, we've probably done about 100 deals in the last 12 months. I'd say the average is somewhere around 3 to 4 million, right? Like most of the issuers we work with, Jordan, start with a Reg CF and then move into a Reg A. So it's kind of like a growth factor, right? A lot of companies, if they've never crowdfunded before, we always tell them, or if they've never done one of these raises, we always tell them start with the Reg CF because you can start to build the community, you can create momentum, and it's much better to oversubscribe and max out an offering at 3, 4, 5 million than to go at a $10 million offering and get the same amount, right? From an optics perspective and from an interest perspective, it's much better to create that validation of we've had a successful raise, we've done this before, we know what we're doing, and then grow into that, right? And so it's more of a step function because the valuation grows like that, you're reducing the overall dilution, and the previous investors are seeing a paper growth in their shares.
Right. So on a Reg A offering, which
Hmm.
as you mentioned, kind of reached a fevered pitch in around 2015. There were a lot of deals that went out, and
Hmm.
shortly thereafter, uh,
Hmm.
those deals all suffered tremendously. And I did an examination into that because I had a company approach me that wanted to go public using the Reg A because they had seen other companies that had done it and had very nice valuations. However, their valuations were fast dropping. Um,
Hmm.
and as I looked at that, I saw that the principal firms, there were two of them that did all these Reg A's. I mean, you had to have a sponsor. In this case, I'm assuming you'd be the sponsor. But back in the 2015, 16, 17 timeframe when I was looking at this, the sponsor was two brokerage firms, um, neither of which had their own sales force. So they had no distribution. All they
Hmm.
would do is they said, we're going to sponsor you. And they didn't even do it electronically or online like you're doing it. They just said, we're going to run this deal. We're going to be the conduit, that gets paid on the whole thing. And from our fees, but then we're going to pay the sales agents. And the sales agents
Hmm.
they used were third-party brokerage firms, retail brokerage firms, just basically syndicating the deal out so that the primary uh, leader in the deal, which was one of those two firms. Again, they did not have any sales themselves, so they didn't control the sales process. They then went to somebody else, sold the deals out um, to them, and those firms are kind of like effectively brokerage firms that, in large part, they're high volume, you know, get a client in, have the stock go up, get the client back out, um,
Hmm.
and then invest in the next deal because that's how those brokers are being paid. They're being paid for each time they put a client into a placement. Um, and that to me was the reason why all those Reg A pluses fail. I mean, some of them were just bad businesses, but others, when they
Hmm.
have a legitimate real business, they failed too as a stock in the secondary market once they were public. They
Hmm.
failed because everyone was just cycling out of the stock, and they had no real fans and enthusiasts, which
Hmm.
you're taking a different approach. You're giving us our own fan base already. You're just enabling our fan base, our enthusiasts, to be now become shareholders,
Hmm.
which, in my opinion, is going to lead to a stickier shareholder base, and we're not
Agreed.
the stock drop off like that. Um, what is? I just wanted to ask, with all of that I've just said, what is your experience with the Reg A Plus process, and what am I missing, if anything, amongst the differentiators between how it was done in the past and how you do it?
Yeah, I think the honest answer is when reggae first came out, I think with any kind of new exemption and financial instrument, there was people looking to take advantage of it, if I could put it that way, right? And I think that's common in the markets. I think it left a bad taste in people's mouths, and I think the industry's trying to change, right? Like what we're seeing and what we're really aiming for is working with higher quality companies and making sure that things are fair, valuations are fairly disclosed, and that they're reasonable and defensible and all this kind of stuff. Um, but the big thing is, the industry has to grow, and for the industry to grow, companies have to successfully raise capital, go through their life cycle, exit, investors have to make a return, and that's going to signal to even higher quality companies that this is a funding option, right? We had the Newsmax IPO, they raised at $10 a share. When they listed on the NYSE, the stock popped, and I think they were at 225 for a few days. And most people that were in that deal made money, right? So like as one example, um, what we're trying to do is we're trying to tell companies, hey, this is a way to raise capital, not a way to take advantage of retail investors, right? Like that is against our ethos of, just set whatever valuation, do whatever you want. We want to make sure things are fair and that people can get an upside, right? And the other thing to your point is, you know, we see this borne out. Companies that have communities, these retail shareholders hold for the long term, right? And I think we've seen this even in the public markets with some of the, you know, meme stocks, if you will, with GameStop and Bed Bath and Beyond and so on and so forth. People are really backing these companies because they believe in the business, they believe in the management team, they believe in what the story is, and it's an us versus them battle, right? The everyday person versus the big scary hedge fund or these folks or whoever. So you're having a different kind of shareholder. You're building up a different class of people with different motivations for seeing the business succeed and what they're trying to do. It's not just the quick flip and the quick trade to get in and out of the stock. It is trying to hold it and build for the long term. If you start doing that when you're private, it gives you a lot more runway and a lot stronger of a base for when you list instead of just listing a company brand new with a couple thousand shareholders who are expecting to do a quick flip. These people are growing with the company, they want to succeed, and they built the company with it, right? So that's really how we kind of see this. We want investors to make money. We want people to win, and we want companies to do this for the right reason and to be successful doing it, right? So that's really what we're trying to focus on.
Can this be combined with a brokerage firm's institutional offering?
Sure. Yeah, I've seen parallel offerings. Energy X, for example, did whether it's private or public, Energy X did a Series B that was led by GM Ventures. It was a $50 million Series B. At the same time, they were doing a $75 million Reg A, right? So you can have parallel offerings. We see it all the time. Um, and of course, as long as it's sufficiently, disintegrated, there shouldn't be any issues. So obviously council can advise companies on how to best do this, but it's a common strategy that we see.
Okay, great. I think we're out of time here, but I just wanted to ask one last question that kind of dovetails with with the prior one.
Sure.
So how do you get paid? Because typically as an IR firm, we know when we use investment banks, they get roughly, call it 8%. Uh,
Hmm.
some cases they'll take less, but generally speaking, 8% is the standard rule of thumb here for
Hmm.
what the broker dealer would get paid, the investment bank. What do you get
Hmm.
paid? And what is there is it commission? Is it fees? How does it work?
Yeah, so we have some upfront fees to create the assets, right? We have a full-on marketing program. Someone will work with, our team's 8 to 9 people per file. So there is some upfront fees to just create the assets for this. The majority of the money we make, Jordan, is on the back end in the form of success fees. Um, a little bit less than what those investment banks would charge, right? Because credit card fees and all the like. But we make money if people raise money, right? So we try to align our incentives. We have some overhead that we have to cover just by staffing the file, but that is meant to just offset that. Like for us, it is not about taking a wide variety of clients. We actually don't want to just work with anybody. We want to work with people that we feel we can raise money for and help them raise money and be successful. And if they are, then we will be fairly compensated for that. And that's really, what we're trying to align ourselves with our customers with, right? We don't want to sign folks just to have an upfront fee or anything like that. That's not going to be, it's not productive for us. It's actually going to cost us money. So that's our philosophy.
Okay, well, that's great. Thank you very much. A
Thank
lot
you,
of
Jordan.
information there, a
Appreciate it.
lot of options for capital raising here, and you go very deep, so it's terrific. Um, and we're out of time now, so that concludes our monthly installment of Tech Tuesdays with Darrow Associates. Thanks to Paul Matiychuk from DealMaker for him speaking about his firm's latest innovations for raising capital online through their digital marketing. And thanks to all of you who participated in keeping your IR knowledge base at the cutting edge. Please join us in July when we talk with MeetMax about their latest innovations and how AI is influencing their product suite. Until then, we trust our Tech Tuesday sessions are helpful in implementing your IR strategies. Thanks again for joining us, and goodbye to everyone.